Good afternoon, good afternoon, good afternoon. Or at least that's when I'm doing this live. Welcome to my first official Lunch and Learn. We're going to call it Lunch and Learn number 1. Shouts out to everybody that is watching the show live right now. Shouts out to Ty Davidson and Adrian Williams. Mocha Bella joins us on a Monday afternoon. I think everybody's kind of recovering from, hey Mocha, I think everybody's kind of recovering from the Super Bowl event or party they attended last night. But it's all good. It's good. It's a Monday. It's 12 noon Eastern time. We're going to talk a little bit about life insurance. And I plan to do this, maybe once a week, maybe different topics, all concerning life insurance. So tell somebody about it that doesn't have life insurance, that needs to get some. Your kids, your parents, your brothers, your sisters, that type of thing. So the plan is each Monday, and if we change it, I'll tell you about it in the Two Live Stews Facebook chat group. But if we change it, I'll make an announcement about that. But as of now, right now, I'm going to try to do every Monday at 12 noon for 30 minutes or so and talk about a particular topic in the world of life insurance. All right. So grab a pencil and a sheet of paper. Some of y'all might have questions. Y'all want to, jot down some notes. And then at the end of, I guess, my little presentation, I'll answer some questions from the chat room. Okay. So grab a pencil, take some notes, and let's get into it. All right. So I work for a Fortune 100 company that's been in business for right at 175 years. Did you know that studies say up to half the people who die in the U.S. have no life insurance? And I bet you the numbers are higher in our community. I just bet, because there's a long history of life insurance in the Black community. There's trust issues that I won't get into in this episode, but there's trust issues because of some tomfoolery that happened many, many years ago. But just understand, this industry is super, super regulated. So 9 times out of 10, when you talk to anybody in the life insurance industry and you talk about their products and their services, everything's going to be in the up and up, because they just don't let anybody get into the financial services industry, period. It's as simple as that. But my company's been around for right at 175 years. We're a Fortune 100 company. And if you don't have life insurance, what you're in effect doing is you're leaving your kids to scramble for the final expenses and making them financially stressed. And I don't think anybody wants to do that. I don't think anybody wants to, it's a bad situation already that you passed away, or whoever the person is that's going to be the insured passed away. But now you got to add on top of it the financial stress that comes with trying to come up with money and passing the hat and doing GoFundMes for something that, once again, and I'm probably going to mention this a couple of times, is fairly simple to get enacted and get done. All right. No one wants to leave their family in a bind, especially when the process to get life insurance, once again, is so easy. Okay. So the way I do these, this is the way I do it in person as well, is I talk about the 2 main insurances. I don't care who it is. Most people, they have questions. They need to first understand about the 2 main life insurances that we talk about and that we deal with. All right. And I'm going to kind of break down both of them. And then I'm going to give you an example, an illustration example of some numbers. This is why you need your pencil and a sheet of paper so you can write this down, or pen and a sheet of paper so you can write this down, or take notes on your phone, because there should be some questions that are spurned from just me breaking this down, okay? So the 2 main types of life insurance are term and whole life, okay? So what is term insurance? Term insurance is life insurance for a certain term. All right, it's very simple. And usually the term is like 10 years, 20 years. Most companies don't do really 30-year term policies anymore, but there's some companies out there that will do it. My company does it, okay, as well. So if you're young and you want a 30-year term, you want to buy it and put it to the side and forget all about it or whatever, and just understand that you're covered, I actually can do a 30-year term as well. But a lot of companies do not do 30-year terms anymore. All right. And so what that means is at the end of the term, the policy comes to an end. Okay? So at the end of 10 years, think kind of like leasing an apartment. Okay? At the end of the term, you have to renew the lease or you have to move on to another place. Okay? So it's the same thing with term. At the end of the term policy, the term of it, the 10 years or 20 years or the 30 years, you have to renew a policy, get another policy, and then in that case, the premiums are going to be affected by your age increase. So it's going to be higher than when you first had it, okay? Or you got to go without life insurance. The policy comes to an end, okay? The great thing about term life insurance is it's super, super cheap. And when I give you these numbers here in a second, you're going to understand what I'm saying. When I say cheap, it's super cheap. And I'm going to tell you why it's super cheap here in a second as well. So you can get a ton of term insurance for a very little amount of money. Now, the other part of it is chances are, and this is a good thing, you're not going to die within that term. I'll get more into that in a second. So you can get a ton of coverage for a very little amount of money, but understand that it's going to come in and end at some point, and you need to get another new policy, okay? Thus, I'll get more into it once again in a second. That's why it's super, super cheap, okay? The other life insurance is whole life insurance, okay? Guess what? Just like term was for a certain term, whole life is for your whole life, okay? As long as you make the payment, the policy never comes to an end, okay? If you make the payment, the policy never, ever comes to an end. Very simple. A lot of times they'll call whole life insurance permanent insurance. They'll call it guaranteed insurance, all meaning that if you pay, it's your policy forever until you have to hit that dirt. Okay? All right? Very simple to understand. Think of whole life insurance like buying a house. Okay? Think of whole life insurance like buying a house. The house eventually is going to become yours if you continue to make the payments for 30 years or however long that you finance the house for, 20 years or whatever the case may be. There's going to be no more payments at some point in the house. This continues. The payments on a whole life policy continue for the rest of your life, but it's your policy as long as you keep making the payments. The thing about whole life insurance, though, is it's very expensive in relative term to how much the term policies cost. Okay? Why is it so much more expensive, Doug? And I'm going to give you these numbers here in a second. Why is it so much more expensive, Doug? Because the insurance company knows they're going to have to pay you, or not actually you. They're going to have to pay the beneficiary, the death benefit to the beneficiary. They know they're going to charge you a lot because, hey, listen, I'm going to stop right here. There's a fallacy out there, and I don't know how it's gotten out there, but there's a fallacy out there that insurance companies are charity companies. No, they're in business to make money. Insurance companies, this is you may not have known this, but insurance companies are in the business to make money. Okay? And so if they know they're going to have to pay this death benefit at some point, they're going to charge you for it. There's a higher price point for whole life insurance than there is for term insurance because the insurance company knows they're going to have to pay it out. And here, I'm going to drop this in there, and I think maybe I had this scheduled to talk about a little bit later. Going back to term, and I got to come back to whole life because I'm going to tell you some more features on whole life. But going back to term, I think this kind of applies at this point right now. You may not have known this, and a lot of insurance agents aren't going to tell you this because a lot of these companies are in the business, once again, to make money, but term insurance is basically a faucet of money. Okay? I'm going to drop this number on you. 99.6% of term policies are never paid out. You heard me. You heard me correctly. Statistics say, not just for my company, but the industry-wide, 99.6 or 7% of term policies never pay out. Why is that? Because the older you get, the more expensive a term policy is. it's priced to a point where they know you're going to die. I don't know if you know what an actuary is. An actuary basically is a scientist, a math scientist slash genius that figures out based on data from the last 100 years and recent years when you're going to die. I know it sounds crazy, it sounds morbid, but when I do a policy, they actually show based on the information I put in, whether you're in good health, you smoke cigarettes, you have a hazardous lifestyle or whatever, it actually shows on the policy your expected age you're going to pass away. It shows it. So it's kind of like Vegas. This is really kind of like Vegas. And, you know, when you play poker, you know, maybe poker's not a good example. When you play blackjack and you play craps and you play all, the house has a 1% advantage. Insurance companies have way more than a 1% advantage that in this transaction, they're going to win. They are going to win. They've done the studies. They know the history. They know that they can give you this policy for very, very cheap because they're never going to have to pay it for the most part. Now, don't get it twisted. The price point is so inexpensive that you still need to get term insurance. Okay? Why do you need to get term insurance? You need to get term insurance because it is super cheap. And if you are that one person that passes away out of 100, less than one person that passes away at 100, you've got a ton of death benefit that's going to be available to your family, to your wife and your kids, that's going to replace your income. So a lot of people think that life insurance is like a come up, get rich scheme that you luck into. No, and that could happen. Theoretically, that could happen. You could pass on generational wealth by a very inexpensive life insurance policy that you paid for to your family if you come to an untimely demise. Okay, that could happen. But no, the purpose of life insurance is to protect your assets and continue the income that you are bringing to your family in the event you're not there. That's it. It's not really designed for your family to come up and they have this generational wealth. Yeah, that's a byproduct of it. But at the end of the day, the point of having life insurance is to replace your income. That's it. Imagine if you got hit by a bus today and you're making $100,000 a year or you're making $200,000 a year and your wife and your kids, your wife is a stay-at-home mom and your kids they want to go to college. You know, they want to get their first car or whatever, but you're gone. Your income, your $200,000 a year is gone. That's what life insurance is for. Okay? That's what it's for. Primarily, it's to replace your income in the event that something happens to you. Once again, there's a less than 1% chance statistically and historically that that's going to happen. But if you are that one person, your family's straight. Your family's absolutely straight. Okay. The other part about whole life insurance is that whole life insurance, a lot of people use it for accumulation benefits. They use whole life insurance and technically they're not supposed to do this, but a lot of wealthy people use it as a tax haven. Let me back up and tell you exactly what I'm talking about. Whole life insurance builds cash value over time. What do you mean, Dougie? Okay, let me stop right there and break that down to you. I'm putting you all on game, okay? What insurance companies do is they get your premiums, they pool it together, and we're talking about whole life insurance and really insurance, all the premiums that they take in, term or whole. They take your premiums, they pool it along with all their thousands and maybe even millions of other clients, and they invest with the top money managers in the world. Their top money managers in the world take all your premiums and they invest in the financial markets. What have the markets returned over the last, 100 years? Between like 6 and 9% conservatively. Some years it returns 20% or more, whatever. That's very rare. I don't want you to think that's the case. So they invest in the financial markets, and their returns, they share those with you in what they call dividends. Okay? So you build, and most of the time you don't get the dividends. They're reaffirmed in your in their financial portfolio. So they reinvest them over and over and over and over again, and they accumulate cash value that you can pull from anytime you want. Listen to this. Listen to this. Tax-free, if set up correctly. So, and maybe I'll talk about this. I just thought about this. Maybe I'll talk about this on the next one of these that I do. There's a term in our industry called the $1 million baby. Okay. So you get a life insurance policy on a newborn. You continue to pay it their entire youth and teenage years. And when they become an adult and they go to college and they come out and they get a job, you transfer the policy to them and they continue to make the payment. Every year, this thing is accumulating. And the power, okay, the power of growing money is incredible. Compounding interest is the term I was looking for. The power of compounding interest is incredible. So the child is an adult. They get this policy from their parent. They continue to make the premium payments. And, you know, when they retire at age 65, there's a tremendous amount of money in this policy that's compounded over and over a gazillion times. And by the time they retire, they're a millionaire based on how much the premium is and how much the policy is. And remember, okay, two things. The term policy comes to an end. The whole life policy never comes to an end. So this $1 million baby thing that I'm telling you about is really something that we talk about dealing with whole life insurance. So back to what I was saying about the tax-free, you can pull this money tax-free. There's only a couple of investments. Now, I think it's a good time for me to say this as well. I just don't sell life insurance. I do financial planning. Series 6, Series 6.5, different insurance exams that I've had to take over the year. So I help people with financial planning as well. The bulk of what I do, though, is life insurance. So over a certain period of time, this money is compounded, and you have access to it anytime that you want. Now, it's going to reduce the death benefit by the amount that you take out, but you can take it out and it's tax-free. And I was about to talk about tax-free investments. Okay. There's only a few. Okay. There's Roth IRAs, but you're kind of limited in how much money that you can put in a Roth IRA. Okay. There's bonds, municipal bonds. But once again, you don't get big returns of municipal bonds. So the whole life insurance over a long period of time, and then we're talking about a long play here, over a long period of time is a tremendous investment. A lot of insurance companies talk down on whole life insurance because they don't sell it. Okay? Remember I told you earlier about how term insurance is basically a right to print money for insurance companies? It is. So be very skeptical when you talk to an insurance agent and they shoot you down, or if you have a question about whole life insurance, they shoot you down, say, oh, that's no good, or this, that, and the other, whatever. That's an absolute lie. They're telling you that probably because they don't sell it. And they want to shoot down any company that does it. But understand the biggest insurance companies in the world and a lot of millionaires base their portfolios on whole life insurance. All right. So I don't want to get too deep into that. Maybe that's what I'll tackle and give you some actual numbers from the $1 million baby concept on one of these next lunch and learns that I do. Okay. So monies that you pull from the cash accumulation from a whole life insurance policy are tax-free. Once again, I just talked about municipal bonds and Roth IRAs are some really the only other investments that you can pull from that are tax-free, and they're very limited. Every other investment that you talk about in this country, you're going to have to pay taxes on the gains. Whatever you make as far as the gain, the increase in value, you're going to pay whatever your tax rate is on the gains. Understand that, okay? So here's what I did. I actually went in and did a couple of illustrations on the cost to let you see a comparison to the cost of a term policy as compared to a whole life policy. Remember, term is very, very cheap. It's very, very cheap because chances are you're going to outlive the term and the insurance company's not going to have to pay the death benefit anyway. But it's great because if you are that one person out of 100 that gets hit by a bus, or whatever the case may be, you leave here early, a big death benefit is going to your family. So I'm going to do the term, and then I'm also going to do a whole life, same variables, so you'll understand the price difference. All right. So we're talking about a male age 45, non-smoker, average health. I'm going to repeat that. And y'all should be writing this down. A male, 45 years of age, non-smoker, average health. Okay? Now, if you're talking about a younger person, the same price for the same policy I'm going to quote you on is going to be lower. And why is that? Because it's more years for the insurance company, to have to pay you out the death benefit. And I don't know if I said that correctly. Let me back up and say that again. The younger you are, the less close you are to dying, is what I was trying to say, okay? So if you're younger, this price point is going to be a little bit cheaper. If you're a woman listening to this example, it's going to be cheaper for the same age, the same health as a man. Why is that, Doug? Because women live longer, historically. Not only do women live longer, but they don't do a bunch of stupid-ish to get them killed earlier. Like there's less women riding motorcycles and jumping out of planes and scuba diving and stuff like that. And they ask you these questions when you're doing the application, because if you're doing something risky, it's a better chance that you're going to die early and that the insurance company is going to have to pay out your death benefit. So it's this rating thing. That's why they ask so many questions when you're doing a life insurance applications, because they need to know about everything that you do, because the less risky you are, the less chance they're going to have to pay out their money to your beneficiary. Y'all got it? All right. So a male, 45 years old, non-smoker, average health. All right. For a term policy, a 15-year term policy, y'all should be writing this down, $500,000 is $97.01. Y'all got that? 15-year term, $500,000, $500K for $97.01 per month. I mean, you probably, if you live in Atlanta, you pay that in parking definitely in a month. That's another conversation. You pay that in parking, whatever restaurant or club you go to. That's a couple of drinks a month, because you go to Atlanta, in Atlanta, you buy a drink, it's damn near $25, including the gratuity. So basically 3 drinks a month get you $500,000 coverage in the event that something happens to you, goes to your beneficiaries, your family most times. Whole life, in comparison, for $50,000 is about the same price, $106.71. So you're both paying right at $100, but for the term you get $500,000, and for the whole life you get $50K. All right? And you're watching the live Lunch and Learn with Doug Stewart. Well, you're watching it live right now. You're watching Lunch and Learn with Doug Stewart. We're talking about life insurance. I want you to make sure that you understood what I just said. Same age person, same health. They don't smoke cigarettes, anything like that. Cigarettes are super, super bad. That's going to increase your rate tremendously. So just understand that if you smoke cigarettes, you're going to pay, because I don't know how else to say this, but you're probably going to die very early in relative terms. That's how bad cigarettes are. I don't mean to offend anybody. Trees give me. Why would you say that? Because I'm keeping it real with you. You're going to pay considerably more if you take the blood test. Anything over $100,000, most of the time, insurance companies going to make you do a medical exam. Okay, you can lie to them and say I don't smoke, but if you smoke, smoking is going to stay in your system. Nicotine is going to stay in your system for 6 months at least, and I think it might even be longer than that. But I'm going to say, to be safe, 6 months. And if they detect nicotine in your medical exam, you're going to be charged for the same insurance as somebody that's in good health that doesn't smoke by a lot. So you need to quit smoking. It's going to kill you early. I'm just going to tell you like that. So Once again, to recap, a 15-year term. Now, at the end of that 15-year, once again, you got to get another policy, you know? And if you're too old, most companies won't even sell you a term policy once you get a certain age. You know what that certain age correlates to? That certain age correlates to when they think you're going to die. So if their illustration or their calculations that they ran in that whole process at the beginning, that you're going to die at age 85, when you get age 70 and you try to get a term policy, you could get it, but you're going to pay like thousands and thousands of dollars a month. So it's all yin and yang. You know, there's a reason for every single thing, and just understand that at the end of the day, the insurance company is in business to make money, okay? So once again, to recap, a 15-year term policy, which you need if you have a family and your income is going to be replaced. So I'm not telling you one is better than the other. Actually, when you're a young person and your family is depending on your assets, they're depending on your income to live, to do all of the things and keep the same lifestyle, it's actually a good idea to get term. And if you can afford it, you have some extra change at the end of each month, you know, get some whole life as well. It's kind of like a pendulum. The older you get, the less and less term you want to have, and the more and more, here we go, and the more and more whole life you want to have. Okay? If you can afford both, you want to do both. Okay? So once again, just to recap, 15-year term, $500,000 in death benefit going to your family, to your beneficiaries, $97.01. $50,000, okay, of whole life insurance for $106.71 per month. That's how it works. Now, once again, the benefits you're getting from whole life insurance, you can, and a lot of people aren't even concerned about the cash accumulation I talked about in the whole life policy. So they're really not concerned about that. They're concerned about the death benefit. They want to make sure they have a death benefit for the beneficiary, so they go with whole life. And we can figure out which one is better for you. Or I'll be honest with you and say, hey, listen, at your age, and if you want to start, you know, growing some cash, I suggest you get both. I'll give you my suggestions. You make the final decision, but I'm going to give you my professional opinion. Maybe you need both. Maybe you need this term. Maybe you need whole life. If you can afford it, Mr. Customer, I suggest you get both. I'll do that. Okay. And there's also a third, I guess, frequently bought insurance policy. And I didn't want to get too deep into it today. Maybe it's another show as well. It's called Universal Life. Long story short, I'll give you a quick summation on the Universal Life. It's kind of like a hybrid in between term and in between whole life. What do you mean, Doug? So it's more expensive than term, but it's permanent in effect. It goes to age 100. You get what I'm saying? Most people don't live to 100. So in effect, it's a whole life policy. Okay? It's not as expensive as whole life insurance. Okay? But it doesn't build cash accumulation. So that Universal is a life insurance policy for someone that's only concerned about the death benefit going to their family. They don't care about the cash value accumulation. They like the price point of a term, but term isn't forever in effect, once again, to age 100. So this product falls right in the middle. It's not as expensive as whole life, but it's more expensive than term. So, you know, when I do a fact finder, which means I'm gathering all this information to come to what I believe is the best recommendation for you as far as type of policy that you get. When I'm doing a fact finder, at the end of that fact finder, I'll know exactly which one you should get, which one I'm going to refer to you. Now, once again, you may say, you know what? I don't want to do that. I want to get this. My mindset, I want to get that. Absolutely, I'm going to write the policy on you. And I'm going to urge you to come back and let's try to get some more coverage later. Let's look at a different type of policy later, and what we call an annual review, where I'll reach out to my clients every 6 months, every year, just to check on them, see how their policy is going, that type of stuff, yada, yada, yada. Okay. So it really just depends on what you're trying to get accomplished. Okay. Ideally, once again, you may get multiple policies. All right. So it's really not a hard process at all. A 20-minute phone call. I'll gather some information on that fact finder again, which I mentioned, and you will be covered that day. And I talked about this morning on the show, on the Two Live Stews show, and I mentioned this actually just now and before I started the presentation, is don't do your people like that. Don't do your people like that. If you got an elderly parent and you have an idea that they may not have been financially responsible and they may not have life insurance, it's tough to talk about. It is. But you're responsible for coming up with the average cost of a funeral. And I'm not trying to scare anybody or anything like that, but this is what they call a real conversation. The average cost of a funeral in this country is $10,000. If you don't have $10,000 laying around and know that you're going to be responsible for final arrangements for your people, you don't have no brother. Oh, no, you might have a brother and a sister that you think could chip in, but they broke. They done had 20 jobs in the last 2 years. They ain't going to have it. They ain't got it. If you know that, it's going to be on you. You need to holler at me. All right? You need to holler at me. Simple as that. You call me today, I can have you covered by the end of the day. Simple as that. Depend on my schedule. You call me today, I'll have you covered by the end of the day. Peace of mind. Because this is one of them things that you sit up at night staring at the wall, at the ceiling about. I know I need to get this life insurance, but damn, it's too expensive. I don't want to get stuck by a needle. This, that, and this. But you need to do it. It's like one of them things you have to do. It's like an annual checkup. You need to go and get a physical once a year. Damn it, you need to get some life insurance and protect not just for the whole thing about the example I gave about you're going to be responsible for, a loved one's funeral or whatever, and you don't want to have to pass around the hat. The bigger reason is what I talked about in that term is if you pass away, what's your family going to do about the income you were bringing in? It's just going to shut off. Okay, so what does that mean? And I promise you, I'm not trying to scare you. What does that mean? You don't have a life insurance and you're in your 40s or your 30s. You got 30 more years of income producing years, and you step in some quicksand. Like this Gilligan's Island or whatever. I don't know where I came up with the quicksand at. They used to always fall in quicksand at Gilligan's Island. So you fall in some quicksand, you gone, and that $200,000 that paid for the mortgage, that was going to pay for college, that pays for groceries, that pay that car note or whatever, is gone. You just left your family high and dry. Simple as that. All right. I'm going to take a couple of questions, and if you could drop your questions, I'll read them. Thanks for being here. So Tree's got a couple of them starred.
The questions are in the chat, starred and waiting for you and ready.
Thank you, Tree. And Tree I don't know if she's going to do this every week, but she took some time out of her busy schedule to come and help me today with this first episode. That's our producer, Tree. If you didn't know, I also host a show on the interweb, on Facebook and on YouTube, the Two Live Stews, youtube.com, and Two Live Stews, facebook.com. We're not talking life insurance and that. We're talking trash. Basically, we're talking trash. We're talking about sports. We're talking about guy talk and pop culture and hip hop culture and all of that stuff. Okay, so that's Mondays and Thursday mornings at 7 a.m. Eastern time. Once again, Two Live Stews, youtube.com, Two Live Stews, facebook.com. All right, so first question I see in the chat from Chris Williams. What up, Chris? How can you get good life insurance on Social Security income benefits? Well, I mean, it really just depends. You can get, once again, the examples that I gave, and maybe he wrote this before I went through the examples, is very inexpensive, depending on, now, if you're in your 60s or 70s, it's going to be higher than when you theoretically should have got it when you were in your 20s or in your 30s or whatever. The older you get, the more expensive life insurance is. It just is what it is. But I think we do policies up to age, I want to say we'll write a policy on you up to age 73, I believe. Up to age 73. Now, in comparison to the price point when you were 23, it's going to be tremendously different. But you did it. You did it. You made your bed. You got to lie in it. If you waited to get some life insurance at 73, best believe you will pay for it. And a lot of people, what they want to do is they want to get that a $10,000. And most companies, I used to work for another life insurance company, well-known life insurance company, and they really specialized in whole life insurance. And we used to sell these final expense policies. Basically, what it was a whole life policy for $10,000. So you're 73 years old. You just thought about it and realized that, hey, yeah, time's ticking on me. Time's running out. And you have this epiphany. I don't want to leave my kids stuck with paying for this funeral. I'm going to try to get some life insurance. You can get most companies they start as low as $10,000. But at 73, it's going to be a lot. No sugarcoating it. It's going to be a lot. From Ty Davidson, I currently have a term policy that expires in 10/28. So you got 3 more years. And that's another thing about term policies too. Most companies, if you still have dependents that need your income, that are dependent on you once again, nothing wrong with getting it. And I don't know his age. I don't know Ty Davidson's age. But, yeah, you can get a new term policy. Okay? You can get a new term policy. And once again, depending on your age is going to determine what your price point is. The point I was going to make is most companies have a provision where you can convert a term policy into a whole life policy within so much time, usually like within the first 10 years or whatever. You may have a 20-year-old policy, a 20-year term policy, but after or within 10 years, you can convert and get some conversion units, that's another conversation, into a whole life policy. Okay, so Ty, most likely in your paperwork, you can find some language talking about converting your policy into a whole life policy. And for so much term coverage you have, you can get so much in whole life. Once again, the whole life is going to be more expensive. So there's a conversion factor that happens most of the time. From Kip Gordon, what life company does Doug represent? So I work for a Fortune 100 company. And I'd say I believe we're top 4 life insurance in the country. I don't want to mention the name because of compliance. If y'all ever worked a corporate job like this, for me to technically do this and start talking about the name of the company I work for, I would have to get it checked off by a lot of different levels of the business of the company. So I just understand that I work for a top tier, A-rated company that's been in business for over 175 or right at 175 years. From Julius 35C, Doug, what is the amount you recommend your clients to have if and when they pass? Okay, great question. Once again, we're talking about a couple different sets of people. If you are the breadwinner for a younger family, you're in your 30s, you're in your 20s, you need to have a policy that's going to replace your income every year up until that last kid graduates college. So if you make $100,000 a year and your kid is 10 years old, your kid in 12 years theoretically is going to graduate from college, you need $1.2 million to replace your income for everything that transpires in the household, groceries, rent, yada, yada, yada. And then, let me back up. $100,000 to cover everything is dealing with the house. That's your income that you're replacing. And then you need to tack on top of that what you think the cost of college. If you think that the kid's going to go to college and you want them to go to college and you don't want to have them take student loans, just figure out 12 years later when this kid is 22 years old, when he enters college at 18, 19 years old, college is $50,000 a year. So that's $50,000, $100,000 for a sophomore year. 150 grand to junior year, another 50 grand, 200,000. So 1.2 million, your 100 grand a year, add another 200,000. You're talking about $1.4 million in life insurance. Theoretically, the wife is going to have time to get herself together, get her a job, but you're floating it from this death benefit. And the reason why I picked age 22 is because the kid graduates and the kid is out from under you, what your responsibility would have been, okay? And the kid gets a job and he doesn't need the life insurance. He doesn't need that death benefit that the life insurance brought in at the time that you passed away, okay? From Kip Gordon, he says, I had a 30-year term that I got in my 20s. It's about to expire. Holla at me. Did I give the number? Write this number down. Write this number down. I'd love to be your agent. And listen, I have this conversation, kind of like a mini conversation with clients all the time. If you call me, whether you buy or not, I feel so passionate about this business that I'll give you a quick one of these, a smaller version of this little presentation that I'm doing right now as well. If you have any questions, something that you missed, I absolutely have no problem with that at all. But if you want to give me a call, you want to give my number to somebody, I'd love to be your agent. My number is 678-216-4452. That's my business line, 678-216-4452. Shoot me a text. That'll probably be more efficient. Shoot me a text. I'm interested in life insurance. That's all. That's all you have to say. I'm interested in life insurance, and maybe type your name as well, text your name as well, and I'll give you a call back and we'll have a conversation and see if I can help you or not. Once again, 678-216-4452. That's production, Tree. That's production. A couple more. Let me read these from Julius 35C. Hey, Doug, my wife and I created a trust for our kids and have linked our life insurance to it. If we leave this earth, how do you link trust to life insurance? So I am not a trust attorney, but I actually have a trust in a state attorney that I work with. Okay. There's different concepts out there where families, it's called, the one in particular, I've worked with several people this past and maybe the last 2 years. It's called the Rockefeller effect. And if you know anything about the Rockefeller family, they're like the richest, wealthiest family in the country for many, many decades. And maybe they still are today because of this Rockefeller effect that I'm about to tell you about briefly. Basically, what I mentioned earlier is the Rockefeller family, the minute a child was born, they bought a life insurance policy on the child. Okay? And in this trust, portions of the death benefit that were paid out later were paid out to the child so the child could live like a rich person and start a business or whatever, and then went back into the trust. See, these is grown men, white people games that we're talking about right now. Okay? So it's called the Rockefeller waterfall effect. Continuously, their money, remember I mentioned earlier about that compounding interest thing? Okay? So they bought a life insurance policy on any newborn to the child, kids, grandkids, great-grandkids, the minute they were born or they were old enough to get a policy, which is you can get a policy for a 1-year-old. They bought a policy on the kid. Not just a policy like me and you talking about, a policy worth $30 million. And they, remember I talked about that transferring the policy to the insured. So there's the owner of the policy, and then there's the insured of the policy. The owner is the parent most times, and the insured is the beneficiary, is the kid. Okay, it's not the beneficiary. The insured is the person that the policy is being done on. Okay, and so, yeah, remember I said earlier about they got to age. What time is it? Okay, they got to a certain age, and the parent, they started working, and the parent passed the policy on to the kid. That's what this Rockefeller effect is, and that's what you can do with a trust. A trust basically is a legal entity that you dictate what happens with your estate when you pass on. Okay, very easy to set up. I actually work with an estate attorney where we'll actually schedule a meeting. We'll sit down with you. I'll bring her into the conversation, and we'll talk. And if you have an idea or want to do something like this Rockefeller waterfall effect that I'm talking about, I can hit the first part of it where we get the insurance for yourself secured, and then you go to her and you work with her on setting up the trust in the manner that you want to get it done. Oh, there's a lot of things that I do. Once again, I'm just telling you about the life insurance aspect, because that's really, life insurance is really the foundation to any good financial plan. Okay. So Mocha Bella Doug, what if I purchase a long-term insurance and you drop dead all of a sudden? Will you stay? Will I drop dead? I'm not going to pay you. Maybe I'm misreading this text, this post from Mocha Doug. What if? Oh, I think I read it wrong. Doug, what if you purchase a long-term insurance, you drop dead all of a sudden? Will you stay pay it? I don't know what you mean by a long-term. Yeah, but if you buy a 10-year policy and you die within the first 10 years, yes, you're going to get it paid. If you buy a 20-year-old policy and you die 19 years, 364 days before the end of the policy, yeah, it's going to get paid. Maybe I'm just not understanding the question correctly. I'm Ty Davidson. My 10-year term is up in 3 years. Should I look to making changes or wait till time? I think I read that earlier as well. Yeah, you want to look at your options, especially if you're getting older to the point where I talked about earlier, where it's going to start becoming super, super expensive. Absolutely. Jesse Copeland, how much is $1 million whole life policy? Depends on your age. Once again, I can give you a quote based on the information that you tell me. You're going to, in this quote or in this fact finder, I'm going to gather information. You're going to tell me, you don't do a bunch of hazardous things. You don't have any speeding tickets. Yeah. Did you know that your insurance, your life insurance, is affected by your driving record? Did you know that? Yeah. You got a bunch of tickets. That says that you are a dangerous driver and your chances of killing yourself behind the wheel are higher. We might give you a policy, but it's going to be more expensive. That's how it works. So absolutely, there's a lot of different factors. Very quickly, within an hour or so, I can give you a quote based on the fact finder that we do. And you can decide whether you want to change the term, or you want to go a little bit less coverage, or you want to pay a little bit more to get a little bit more coverage. There's a lot of different variables in that whole equation in getting life insurance. Debo Vibes. What up, Dougie? So I'm a type 2 diabetic and recent cancer survivor. I have a difficulty finding any life insurance plan that will cover me for a significant amount. Any suggestions for me to look? You're in luck. Over the past year, the company that I work for also has a brokerage side. And so traditionally, the top tier Fortune 100 big insurance company, legacy insurance companies, they're very, very conservative in who they'll issue a policy to. Like, I'm not going to say you have to be in perfect health, but you need to be in good standing. You can't be someone that's got all these health issues and think that you're going to get a policy from a Fortune 100 big-time life insurance company. The brokerage side of the company that I work for is I'm able to shop your application to like 30 different carriers, is what the term is. Okay? So the company I work for, we submit it to our company, and it gets denied. I take that same application, and then I shop it through the brokerage, and it gets shopped to some companies that specialize in approving hard to approve clients and prospects. Okay. So yeah, if I can't get you approved through my company, then I work in a brokerage aspect as a broker, and I shop your application out to 25, 30 different insurance carriers. And those carriers, there may be one carrier that specializes in approving policies for people with past heart issues. Or it might be an insurance company that specializes in somebody with diabetes. They might give you a little bit more leeway with your A1C. Cutoff number for my people that have diabetes or know anyone with diabetes, they understand what I'm talking about. Cutoff for A1C for top tier Fortune 100 companies like I work for, usually it's like at a 7. Okay. If you're at a 7, you're borderline. If you're at a 6, 5, you're good. You can get a policy for most companies. Higher than an A1C of 7, it's going to be hard for you to get. I take those clients that I can't get approved in my, full-time company that I work for, and I shop those to a bunch of other different carriers that their criteria might not be as stringent as the original company that I work for. So there's a lot. Once again, here's my number, 678-216-4452, 678-216-4452. Shoot me a text, interested in life insurance, your name, and I'll give you a call back as soon as I get a chance, all right? Which will be within most of the times 24 hours. All right. Tree saying bye, like we got to go. She got stuff to do too. I get it. But thank y'all for joining me today. Pass the word once again. My number is 678-216-4452. I'd love to be your agent. All right. Peace.